Chip, if you want to say anything, bud, just chat in the window there. And Trevor, good morning. Uh, Neil, good morning. Ben, feel free to chat where you guys are coming in from today. Oh, glad to have you here for the big show. All right. Think we'll get started here. Spencer, good morning, brother. Let's test the chat. Could one of the attendees chat here? I want to make sure the chat is on. Let's see. Just little details before I get started. Let's see. Chat is not on. Chat disabled. All right. Yeah, there's always like 1,000 little things with the Zoom webinars. All right. Well, I'm not going to mess with the chat. We have the Q&A, looks like it's there. Thank you, Neil. So if you guys got questions, just type them in the Q&A and we'll go from there. So, okay. Super excited to have everybody here this morning. Let me introduce my co-host, Brandon. Brandon is become a friend over this year. He's a super smart real estate investor, real estate sponsor, but more importantly, a good husband and a good dad. And we're excited to be here today with you. Brandon, I'll let you do the intro here in a few slides. I'll just get started. So the number one thing here is the story. So the story here is Ma and Pa sellers. Okay, they own a ton of real estate around St. Augustine, Jacksonville area. They don't have any debt on this real estate, and so they haven't felt pressure to raise rents over time. So they've just been, sitting on these properties, not pushing up rents, not driving up value, and these are the perfect opportunities to look for. So we'll go more into that, but that's the basics. Okay, disclaimer. Brent and I are not attorneys. We're not financial advisors. We're not accountants. So go to those people for financial, accounting, and legal advice. We're going to go over the sponsorship team, a quick executive summary, offering summary, financials, business plan, market overview, Q&A. Q&A is super important, so I'll try to go as fast as I can. Sponsorship team. All right, so this is me. What do I do? Used to run a dental group of 160 team members, founded that. Now I develop locally with about half of my time. We have 125 million worth of apartments in development right now around Spokane. The other half of what I do is evaluate real estate. So I look for great fundamentals, great sponsors, great markets. And when I find something super sexy, and I'm ready to invest, then I'm invite my friends along, you guys. So glad to have you here today. Brandon, I'll let you do your own intro here.
Yeah, thank you. Nice to meet you guys. So, longtime Floridian, been in St. Augustine here about 5 years. My background for 20 plus years is in construction, restoration, renovation, specifically commercial. Married 18 years, three kids, one in college. Um, we're a special needs family, but love being here at the beach, and this is our forever place. So, um, yeah, been full-time commercial real estate now for a little over a decade.
People ask me about risk on deals. The number one risk for me is always the sponsor, the boots on the ground. And I find Brandon to be a truly exceptional human being, which is number one for me: integrity, communication, and then also he's got great experience. And I just love how he processes information, makes decisions, and executes. Brandon's had multiple discussions with the sellers and their attorney and the property manager, and we've managed to, especially Brandon has managed to get the price down on this, negotiate the seller financing. Like, he's very good at executing in a very kind, patient way. So, what
Yeah,
we do, oh, go for it, Brandon.
I was just gonna say, in my previous life, I was um, commercial construction, and then specifically disaster recovery is what I did. Was very, very management intensive, very reactionary, always playing whack-a-mole, and that's where I built my operational chops. And so when it comes to this, um, commercial real estate and this stuff, I just love it because I'm not going to say it's a walk in the park by any stretch, but the pace at things is just wonderful compared to what I used to do.
That puts things in perspective.
Yeah.
I can see why you're not afraid of those difficult conversations. That makes sense. Okay, so what we do, Cochrane Capital, like, my whole vision here is to find awesome properties, great returns, low risk, invest in them, and bring my buddies along with me. I mean, that's what I do. So the high integrity sponsor, we talked about that. I get my gut check on these people. I do background checks. Brandon's came up squeaky clean, personal financials. Our projections, if the deal doesn't project, like when I do the math, if it doesn't project at 20% or more returns, then I don't invest. Like, all I can make decisions on is the fundamentals. If the fundamentals say 20% or more, then this is attractive to me. Location also has got to be location. Like, this county's like been the fastest growing county in Florida, so it's a great area. And say Augustine is historic, beautiful, the A1A highway, it's great. Our model, rinse and repeat. So the highest returns are always in adding value, adding real value. So raising rents, occupancy, and then sell it, right? That's how you're gonna get your highest returns. So we're targeting a 5 here. If we can get everything, all the rents maxed at 3 years, and then we'll go to market and get the highest return for everybody. But the market also has to be ready, right? So people have to be buying commercial real estate that year as well. So infinite return, that's a second model. That's a longer term model we'll do as well sometimes. That's when we buy something, holding it 10, 20 years. We do cash out refinances to get a lot of cash back, tax free, and we just cash flow, right? This is what the wealthy do. And then tax referral. I have a really good tax mitigation strategy coming next year for those who invested with me on the real estate side. We'll talk more about that next year. And the more we raise together, the better we can negotiate with sellers, the better we can negotiate with sponsors. So the more our group gets stronger, the better we'll all do. So uh there's a lot that goes into doing a deal, right? So we find the right people. So this is Brandon here, and we run through all this. It took Brandon and I have to look at the exact start date, but about probably 6 months to get to where we are today. So there's a lot that goes through this. The sellers conceded a lot to make this deal attractive. So thank you, Brandon, for all that work. Okay, executive summary. So we're trying to summarize this offering in one page. And so I'm trying to articulate why I love it. Then I'll go into more detail with pictures and everything else. So, okay, so this is a retail center, about 27,000 square feet on A1A highway, right? A1A highway, you know, going all the way up the coast of Florida, like some of the wealthiest people in the whole country live on this highway. It's a very attractive place. Specifically here we have we have St. Augustine. It's like a mile from St. Augustine, historic, like oldest continuous settlement in the US, beautiful place. And then the beach. So right between these two, it's a great location. We've negotiated seller financing. Like, what does that even mean? Why is that attractive? So we have 6% over 5 years, interest only. Okay, what does that do? That cuts down and shrinks your payments. And it also gets rid of like bank fees and bank requirements. So this increases cash flow, decreases risk. If I could do this on every deal to maximize our returns and lower our risk, I would. So purchase price. So there's three ways to evaluate the real estate pricing. And one of them is what would it cost to replace it? So we're getting this thing at $132 a square foot. Any of you that have tried to build in the last 3 years will know that building this, like buying the land and building this, would cost you at least double. Okay, so we don't have threat of competition, someone building one next door and coming up and matching our rents. They can't. They literally have to come in and charge $35 a square foot, triple net, to build, right? And we're the equivalent of about $8 triple net right now. So nobody can compete with us on the replacement cost. Occupancy, this place varies usually between 92 and 100% occupancy, right? This is a very highly tenanted retail center. So rental rates, again, we're doing gross leases here right now at $14 average per square foot. Anyone that knows retail knows that's super low. That's the equivalent of $8 triple net, which is just astronomically low. The mom and pop sellers have not raised rents. So we have a huge opportunity here to do real value add by raising rents, sitting down, talking to the tenants and explaining it. And we do a collaborative with tenants, right? Firm but fair. But they also don't have anywhere else better to go. There's not like another development where they can go down the street and get good pricing. Most of the retail is $20 to $25 triple net, 28 in that area. We talked about, okay, cash on cash returns. So because we're doing the seller financing and we're buying at such a low price with such low rents, as we raise rents, that's going to increase cash flow, right? Without increasing expenses. So that's why this one has such a great cash flow. And it ramps up too. As we raise rents, it's not like it's the cash really gets high. As I was going through this, like I was like, dude, this is going to be such a good investment. I always serve my investors first, but part of me is like, man, I wish I could just take this whole thing down myself. I mean, I can, but ethically, I always put my investors first. So this has some great potential, and I'll break that down later. Debt service coverage ratio. This is what banks always look at. This measures risk, right? Most deals 1.25, 1.3. This is 1.6. Again, you don't see this out in the market. This says super low risk, tons of cash flow. And as we raise rents, it'll get even better. And the 1 to 2 million here, this is based off of like conservative projections. I'll show you some other projections later that make it even better. So what is the going year one cash on cash? Let me pull that up. Brandon, do you have the year one cash on cash? I think it's like 5.5. I just gotta pull up my PowerPoint. Good question.
That sounds right.
Yeah, five.
In place. Yeah.
Yeah, year one's 5, year two, 7.5, year three, 10.3. Year 4, 16, year 5, 22. So great question, Ben. Thanks for asking. Okay, offering summary. So minimum investment for the fund is 50,000. The structure here is we're going to return capital contributions to investors first, and then an 80-20 split. Total equity raise on this one will be about 1.422. Kindly be aware of the investment opportunities we've granted on a first come, first basis. Our last deal got sold out before I was even able to launch it. That was a $3 million investment. The one before that was 48 hours. So just basically, like, I haven't had a ton of time to promote this one, but like, if you're interested, you really like this, like, please try to get your reservation to me sooner so I can reserve that so no one will encroach on it. Yeah, we need to close on the 25th. And so the sooner I get the funds in, the better. So we'll have the money to close. And if we don't, then I'll just backfill myself. So, okay. Targeted returns. So conservative target returns on this one based off the projections. I can't predict the future. All I can do is look at the fundamentals and base this off the fundamentals. So based off of $14 a square foot triple net, which is not super high. This would be a 2.2 and a 5-year hold. I mean, we might sell it in 3 years if we max out rents by 3 years. So at a 5-year hold with $14 rent, we're looking at a 2.2 equity multiple. So over double your money, average of the 9% cash flow, a 23% average return, and IRR 17.9. Hurricane risk. Trevor, I will get to that. That's yep, that'll be a good topic. I will get there. This is called Lighthouse Plaza. It's in St. Augustine, Florida. Oldest building, I think, is from the 50s. The newer ones are 70s, 16 units, about 27,000 square feet. This is not a small center. Asking price was 4 million. Brandon negotiated this guy down to 3.5. So we're paying about 218 per unit, but this is the real important one. 132 a square foot. Super low cost of acquisition. Down payment, this is how much money we need in the bank to close. Acquisition fee, this is standard for any deal. This pays like Brandon and me for the 6 months of work we did, right? Time. And then closing costs, attorneys, title company, loan guarantee. So Brandon and I have to put our assets on the line and guarantee the loan. And so those are the fees on this one, very low. Rehab, capex, equity funded. So we're doing light rehab on this one, not a ton. The parking lot needs sprucing up. The landscaping. If it's the owners, they're nice folks, but they haven't been proactive about things. So we can spruce this thing up. Operating reserve, always got to have money in reserves. And then there again is the total equity raise. Okay, these are great questions. Henry, appreciate your question. Keep putting the questions in there and I'll try to answer them with the slide that they kind of match up to. Those are great questions. Timeline. So we're launching the deal launch today. I need everybody, like new investors, to sign up on the portal, do deal disclosures by the 20th. I'd like to have the money by the 22nd. That way I can wire it to the title company on the 25th. Yes, Ben, we will get into that. Very light TI, we'll get into that. Seller financing. So this increases cash flow, lowers risk, no bank fees, no prepayment penalties. So here's what we're doing for seller financing. We're putting down $1 million. We're getting seller financing for 2.45, interest only, which creates cash flow, a 5-year term, which reduces risks. Yeah, I mean, yeah, we don't have to keep it for 5 years either. We can refi before that if we'd like. Here's the annual debt service and the final payment amount. This one will be, Brandon, we decided on quarterly distributions on this one. Is that correct? Starting in Q1?
Correct.
Yep. So autonomous, good question. This will be quarterly. There's between monthly and quarterly is just takes a lot of work to do everything every month. And Brandon and I are real estate people. We're not capital raisers. Like, that's not our primary job. We do real estate. We have like full-time job creating value for people. And so we try to focus on that, and quarterly is like the sweet spot where, okay, we're still getting distributions consistently to investors, but we're not spending all our time on admin time. We want to spend our time talking to the tenants, like creating real value for you. So great question. Okay, rent analysis. So as I said, the current average rent for Lighthouse Plaza is $14 a square foot gross lease, which means the owners are paying all the expenses, which is not normal in retail. This is the equivalent of about $8 a square foot triple net. So there's about $6 a square foot the owners are paying right now. Market rent, hop on Crexy, hop on loop.net, look around, you'll see retail rents, like 20 to 28 is the ones I'm seeing right now. And there's very little competition. I'll show this in a little bit. We believe we can raise rents to an average of 18 to 20, but we've only projected in our projections $14. So we're doing really conservative projections here. Here's where we think gross income will go. And this kind of shows as we pay back your capital each year, what the capital balance will be. Here's the expected cash flow for the property each year. And kind of the end of year capital balance. This is the beginning of year, end of year, and then here's the cash flows that you were asking about earlier, Ben. So like this is what value add looks like. Okay, we're not relying on the market, we're relying on our own two hands, which is great. I love running a break-even analysis. This helps us see risk, right? Like how occupied do we need to be to break even on this property? Well, we're getting in at such a low basis, like this is how occupied we need to be. This place is traditionally 90 to 100% occupied, right? We need to be at 64%, 57, 40 as we raise rents, right? So this is a very, very low risk deal. Like I only try to find unicorns, right? Like say no to the good so you can say to the great. Like this is an awesome deal. I hope these sellers continue to sell off their portfolio because I would love to buy them if they're similar to this. And Brandon has that connection through his property manager. So we're going to continue to try to keep a really good relationship with these sellers so we can just hit repeat. 5-year projections. Here's the current value on a 7 cap. Current income, expense, NOI, expense ratio, right? When you're doing triple net, you delete that expense ratio, right? It's just like accounting and a couple other things. This gets very small. So we're walking in at a 7% cap. Okay, people ask me all the time, how do I evaluate good deals, right? So sponsor deal market. Here's one of the #1 things I look at is walk out cap rate. When people are being optimistic, they take this walk out cap rate and they shrink it. Okay, we're not shrinking this in our projections, right? So, you know, I'll get to another slide, but this is something to really look at. If there's one number to look at on how optimistic or how much a sponsor is relying on the market to increase their returns as opposed to the work they're actually doing, look at this number. Okay. But at $14 triple net, this is the expected value we expect to be at. Gross potential rent, triple net income. So like this is charging expenses to tenants like most retail across the country. We're putting in a 15% vacancy rate. Okay. Sometimes as we raise rents, it might be a little higher and sometimes it might be a little lower. Like traditionally, like I said, it's 0 to 8%, but we wanted this in here all 5 years to just, yeah, to add that, be conservative. Economic vacancy, occupancy, yep, NOI. So we're increasing the NOI here and just in this model at 14 by 50%. Okay, that's a big number. So this is a really good deal here. So let's keep going. Okay. Henry, yeah, red states. Agreed. I just talked to a lender yesterday and they're like, it was a New York deal. And they're like, nope. New York follows California. We're not lending in New York. I was like, all right. Okay, so this is probably my favorite slide. Okay, when I built this. So this is called a sensitivity analysis. So this is like the what if scenarios. Okay, so up here, I should have unbolded the NOI. Look at really like dollars per square foot. Okay, think about your local. If we're dentists, we're probably paying like $20 to $30 square foot for our spaces, right? And this is St. Augustine. This is like on the beach A1A. This is not a divey area. This is like a nice area. So we're projecting we can go from $8 a square foot or 14 gross to 14 triple net. Okay. And we're projecting a 7% cap rate. Now, cap rate briefly is like how sexy an asset class in a certain area is to people. Like multifamily usually sells for about 6%. Retail, if it's like a Starbucks, not Starbucks lately, but you know, historically Walgreens, Starbucks, those were like 5, 4%, 3.5% when the market was really hot. 7% is right. This is fair. This is for right now. This is fair. I wouldn't be surprised at all if we were able to get more in this range in 3 to 5 years. As long as the market goes well, I wouldn't be surprised getting something more in this range. So at a 7 cap, like today's market at $14 from adding value, this is a 5,398 value. Okay, so you know, we're buying at 3.5. So that's 1.8 million, 1.9 million we've created by upping these leases. Okay. Now, what's fun, and this is why I love deals. In my buy box, you got to have that 20% projected return based off of the fundamental numbers. But I love deals with upside. That's what gets me excited. So when Brandon and I started running numbers on this, you know, it's like, what do you think these things are going to be? I'm like, well, I think we're going to sell it for at least a 6.5 if the marketing increases, right, in that area. Okay. And then, like, what do you think rents would be? Well, gosh, if we continue to improve this and re-tenant it over time, I'd like to see at least $17 a square foot. I mean, you know, it's in the beach. I don't think 20 is out of consideration when the market's like 20 to 25. So this is how much potentially we could sell it for under those assumptions. Okay. Again, we're buying for 3.5 million, right? And we're doing it leveraged, right? So like actual money in is 1.4. So if you think about that, like 3.5, 8 minus 3.5, that's 4.5 million. You put in 1.4, you get 4.5. So we could potentially like 3 or 4 times our money on this, 4 to 50% potential returns. Again, I don't have a crystal ball. All I can do is act based on fundamentals, but I invest in things that have strong fundamentals, low risk with upside. Otherwise, it's just not sexy to me, right? That's how we do it. Okay. Value analysis. So anytime you guys look at a property, there's 3 ways to calculate value. One is replacement cost. We talked about that already. 132 for us, building new, you're at least 230, you're at 6 million in, which means you got to charge $35 a square foot for your spaces to make it work, to make it pencil. Income, this is the cap rate. We're buying a little over 7. Okay, 3.5. I think market's 3.6. Why this is a good deal, though, is such a good deal is the rents are so low. Sales comp. If you look at all the sales comp, Brandon will go over, we're about 267 in the market. We're buying for 132. This was an off-market deal. Okay, Brandon got this hooked up with the property manager. The sellers later on did try to list it, and they threw it out there, but we already had this thing under contract when they did it. So this is all Brandon having a relationship, a local relationship. He drives by this place twice a day, 5 minutes from his house with the local property manager. Okay, classic mom and pop ownership, at least 30%. We talked about all this, talked about this, cash flow, talked about this. Yeah, it's right on like the CB borderline here. It's not divey, you know, it's not like vape shops and all that. There is a liquor store in there, but it's also like surf shop, a lot of mom and pop businesses. So we're going to kind of move it from C plus, B minus to B. Strong debt service, unyielded. Yeah, you always want at least a year, 1.5 here. This is a little complex to explain, but you want at least 1.5. Brandon, would you touch on this slide? I think, you know,
Sure.
hurricane is a question commonly asked on this one in Florida right now. You want to touch on all this?
Sure. Yeah, let me address the hurricane issue topic. I'm sure if there's folks on here from the West Coast, um, it's been on the news a lot lately. And as a Floridian, living here 20 plus years, it just kind of goes with the territory, and we get a little callous to it. But I will say that if you look up historically, Jacksonville and St. Augustine, because of where they are positioned geographically in the state, were the furthest west on the East Coast. So there's a little pocket here where Jacksonville and St. Augustine sit, and the bulk of the hurricanes over the last 20, 25 years will either go north of us or south of us. So keep that in mind. We did get hit by Matthew in 2016. Um, this building, there's actually three buildings here. When it comes to the different types of risk with regards to a hurricane, you have wind and then you have flood or storm surge and combo of storm surge and flood. This particular property sits very close to the Intracoastal Waterway, the coast, and then the harbor. Um, this property did take on a little bit of water in 2016, about from what I understand, about a third of the property, just a little bit in one of the lower lying spots. Since then, has not had any damage with any of the storms. This is cinder block one-story construction. It's a bunker. I don't think that we have any real risk. And listen, coming from this is the type of construction work that I used to do, right? So I can tell you if I were chasing storms today and I drove by this building, I'd be like, that building's fine. It's one story cinder block. It's not going to get blown away, nor is it going to get like the wind-driven rain type damage that you see a lot in Florida with buildings that go higher than 2, 3, 4 stories and up. Flat membrane roofs, and they have recently been recoated in the last couple of years. So bottom line is there's more of a flood risk than there is a wind damage risk here with regards to a hurricane. I think it's minor. I think that this is just my honest opinion. I think there's, once every 10 years, will this place possibly take on a little bit of water? Like I'm talking, an inch on the floor in a very small section of the property. It would have to be a really, really um, major flooding and storm surge event, like a combination of a ton of rain, high tide, all those things coming together to do that. So that's, just my thoughts on it, being in Florida for 25 years and then also doing that specific kind of work for a living for 20 years. I'm familiar with the structures and what's more susceptible to hurricane damage. The insurance market in Florida is a disaster right now. It's really volatile. There's almost no way to predict where rates are going. Um, DeSantis, our governor, has pledged to continue to bring this up at the state level and trying to get some reforms in place. But we have received quotes for the best possible coverage we could get, which is three policies: hazard, which is your basic insurance like everybody has; wind, which covers hurricane damage from if we have enough wind to do some damage to the building; and flood. So all of those coverages are underwritten into the model that you guys are seeing the projections on. Um,
Brandon, there
yeah.
was a question. It says only supplemental hurricane risk could be damage to the area, and tenants and local residents to support businesses could be affected. Um, so it's not just the building itself. I think that's what the anonymous attendee is saying. It's saying also like the local tenants, the residents that support these businesses that pay the rent could also be affected.
Sure. Yeah, and also we do have BI coverage underwritten into the model as well, business interruption. So if we lose some tenants because, their homes are damaged and they have to close up shop, we do have some coverage for the lost income. But yes, that is a true statement that there could be some indirect risk to the overall market if we were to get really nailed with a storm.
Brandon, how much do we have built into our model for wind coverage? How much per year? Cost of wind coverage.
It's per building, and I would have to go back and look. Um, but it is above replacement costs.
It's expensive. Okay. It's above it. So Brandon, is putting all the insurances in place to protect us on this. I have a completely different point of view as an entrepreneur. Contrarian, right? When people can't find insurance in Florida, in my brain, now is the time to buy, right? Two, when I think about roof replacement, like wind here, okay? I think about how much insurance is. I think we have it built in maybe 100 grand per year, okay? Is what my memory is telling me for wind insurance. In my brain, I'm like, okay, wind insurance is 100 grand per year. Like, I don't want to pay $1 million over 10 years for wind insurance when to replace the roof, it might be 200 grand, right? So because we're having multiple investors in here, we're getting the insurance to protect everybody. But if I own this building by myself, I just do the math, like 200 grand for a new roof, 2 years, that's 2 years of insurance payments, right? I'm going no insurance. I'm just making sure I got 200 grand in the bank to pay for it if I ever need to replace that roof. So I guess what I'm trying to say here is I don't want us to live in fear. I want us to live in reality. Okay. There's a very low chance that wind is going to have an issue here and hurt our roof. If it does, Brandon has coverage, but if this was me just owning this, I wouldn't even have insurance here. Like, I'm not going to live in fear. Like, how often does the roof get blown off? Almost never. How much is it going to cost me if it does? 2 years worth of insurance premiums, right? Easy answer with seller financing, because seller financing isn't going to require insurance, but bank financing is. So the easy answer here, if it was just me, no insurance on the wind. So I just want to change people's perception and look at risks and benefits, weigh those, and make an educated decision. That's what I'm trying to say there. We have insurance on this, but we don't need to be afraid of things. We can make sophisticated decisions. So, okay,
Yeah,
great
and
question. Oh, go for it.
add one thing. We had a couple storms this year, as some of you may have seen on the news. They came in to the state on the Gulf side, but they did come across the state. We're still strong tropical storms, Cat 1 strength, came over the top of us, at least a couple this year, and it was totally fine. The property was totally fine. So again, just to reiterate, it's going to take it would take almost a direct hit hurricane coming in off the Atlantic, plus high tide, plus a major rain event to before we would, you know, have any real fear here.
Good job, Brandon. Thank you. Okay, hurricane risk, covered that. So here's our property right here. Here's the beach. Here's the A1A, like we said. Jimmy Buffett Boulevard. 600 feet of frontage, right? That's awesome. That's such great visibility. 1 mile from the Bridge of Lions. That's the picture we have in between sections. It's beautiful. As I mentioned, St. Augustine, the oldest continuous settlement in the US. This is a great, rich cultural area. It's a large retail center, 3 buildings. We even have a parking lot as well. Our tenant mix, rug retailer, art gallery, surf shop, like clothing boutique. These are like local businesses. So I put this together to show you competition. When you go on Craigslist and you look up retail, this is what you see. So all the retail's here, there's retail down here, but on this 6 mile strip, like there's not much competition at all. So this is a great place to be. And then two, you look at the rents, $28 a square foot, 25. We're at 8. Okay. This says 4, that's per month, right? Multiply that by 12, 48. This is why this is so attractive to me. I just love this one. Um, Brandon, do you want to go over anything here that you want to touch on? You don't need to, if you don't want to, but anything that pops up for you, next couple slides.
No, it's pretty self-explanatory. We already covered. It's a fairly diverse unit mix, rent roll. So I think we're good.
And these are local mom and pops, right? So a lot of these are like short-term leases. Okay. Some of them month to month on their options. What's great about these is we don't have to wait 3 years, 5 years, 10 years to raise rents, right? Brandon, the property manager, they go in, they sit down with the tenants, they, build rapport, explain to them that we're going to be raising rents. And I've done this many times in the past. I just kind of get to know them, build a relationship, and just kind of explain like, hey, this is how retail's done. And just incrementally raise rents over time and have the tenants start paying the expenses. This is our business plan. And the reality is market is so much more expensive than these folks are paying. And so this is very fair. I did this last year with an attorney group. It was no problem at all. I just showed them the numbers and they signed a 5 or a 10-year lease. I can't remember, with rent increases in it. If you just give people like the real numbers, let them make the decision for themselves, they'll see that there's like not a better place for them to go. Second set of tenants here. Brandon, I think the rest of the sides are pretty much you. Do you want to kind of take over and then I'll just kind of support?
Yeah, sure. Um, yeah, Spencer asked about tenants. Um, they know it's coming. For the most part, I would say yes, they know it's coming. Most of these tenants are smart enough to know that they've had a really sweet deal for the last couple of years. Um, this is a situation where the landlord has honestly done the tenants a disservice because now they're in a position where they know these rental rates increases are coming and they go out to market and they look on LoopNet or Crexy or Facebook Marketplace, wherever they're looking, and they're like, oh shit, like we can't, there's nowhere else to go, right? So then it becomes a decision of the viability of their overall business. Can we afford, and that's where we plan to go in and meet with each one of them individually, have a good, honest, candid discussion and see what they can stomach. My personal opinion is we want to push as much as we can push. I'm not looking to put people out of business, but at the same time, if you can't afford market rate, you really don't have a viable business. So in some cases, vacancy is going to be a good thing. Um, yes, I do have some sales comps coming up, but I tried to come up here with some really good like kind and quality um, comps here for the rentals. So you can see, the lowest here is $20 a square foot. Again, if we can get 16, 17, awesome. And the return profiles you guys are seeing in the model is based on 14.
You want me to go to the slide, the sales comps? Yep.
Yeah.
Okay.
So these are some sales comps that a broker friend of mine put together from this year. Tried to get as many from this year, so as recent as possible. So you can see there's some here that are a couple miles, from 2.5 miles the closest out to 30 miles for like, kind, and quality. $177 a square foot was the lowest. And I will tell you that that is a more um, rural location. It's kind of out on a two-lane highway. There's not much around it. So a much less desirable location. So you can see, again, just the attractive basis. We're coming in at $132 a square foot. I
Good.
think, yep, good.
You can just tell me next slide. When I hear next slide, I'll just enter in stuff,
Sure.
questions, and I'll just go when you say next slide. So
So there was a question in the chat about CapEx improvements they will see. So uh, we're just gonna clean up the place from the exterior perspective. It's a little tired. Um, there's not a lot of care and attention that goes into the exterior. They just kind of do the basic bare bone minimums, right? They keep the grass cut and they keep some basic stuff operational, but that's about it. Um, so we want to paint it. All three buildings are painted different colors right now, kind of like an old, out of date pastel Florida colors that you would see in the 80s and 90s. We plan on painting all three buildings more of a white with a dark trim to match. So all three buildings will look good. Add some landscaping, add some color, add some tropical flowers, things like that, just to give it a lot more curb appeal. But also keep the authenticity of the local neighborhood strip center. So we're not trying to take this thing to attract, national regional tenants. We still want to maintain the feel and the reputation that it has with the locals as well. I already have a quote to paint the entire exterior landscaping, and then there are some areas around the perimeter of the buildings where we can create some additional parking, which is going to be important if we're going to increase the overall volume and traffic of the facility. You can go to the next one, Josh. So this is how it currently looks today. You can see, again, like I said, that kind of old tired green and blue that that was popular 20 years ago in Florida, but not so much now. So um, again, we're gonna paint the exteriors, the stucco and block. The columns there will probably do like a darker color, um, dark gray or even a black maybe. Add some landscaping and some colorful flowers to add some contrast there. And then around the back of the buildings, we'll add some more additional parking. This is just an aerial here of the three structures. And then the little square up in the upper left, that is an additional parcel that is included in this deal with commercial zoning. And right now it is used for overflow parking for employees of the businesses at the center. So the overall plan, again, we've covered this a good bit already, but rate management, lease management, that's the low-hanging fruit on this deal. Professional property management and leasing, it already has a good reputable property management and leasing group on it. That was my going in reputation. That's how we got this opportunity. It was brought to me off market. The guy gave me about a week early look, and we jumped on it. So we will retain the current property management leasing company that's on it. He has been somewhat handcuffed, has been wanting to push rates and push rents and convert to triple net, but the owner is just not really allowed them to do that. The current owner, again, classic mom and pop, has a lot of personal relationships with the existing tenants. And quite honestly, they just didn't need the extra income. So they had no real motivation to push rates. Capital improvements, I just covered. Uh, I think someone else in the chat asked about TIs. Just so you guys know, this is not we don't really have much of a TI market here. Unless you're going like class A super center type retail, but this class of retail in our market is more of um, it's kind of an as is, take it, tenant responsibility. So previous tenant moves out, new tenant moves in and is responsible for any TIs that they want to do. That's pretty standard in our market here. Um, Optionality.
Yeah.
I'm sorry, let me back up. I want to cover this condo conversion. So one of the options that we have
Or-
in the state of Florida, you can do commercial condominium conversions. So we cannot do it early on while we have the seller financing, but if we recapitalize this and refinance this project and decide to hold on to it instead of selling it, we can convert all the units into commercial condominiums. And it is pretty easy here in the state of Florida. It's not like residential conversions are very, very difficult, but commercial are not. And so then we would have the option of selling off the individual units. And it's kind of like the buy wholesale, sell retail strategy, right? Like going to Costco and buying a case of water and then selling them off individually. It's kind of the same concept here with the condo conversion. So our basis is 132 a foot. We could potentially sell off the individual units. Um, right now, market would be, high 200s a piece. So that is an option at some point. And then optionality again with um, kind of the basis and where we're at and our starting point in this project, we feel like once we get this thing stabilized, we're going to have some options as far as any kind of disposition, recapture, a recapitalization, or the condominium conversions. We got some options.
But to be clear, all investors will have the opportunity always to get their returns out in the
Sure.
5 year. So we're not gonna make everyone stay in this. If we say 5 years, then yeah, you will have that opportunity. But we want folks to know that there are some other opportunities here that we're not focused on. But it's nice to know they're out there. That we could do here in a couple years. Market overview, Brandon.
Yep.
Oh wait, sorry, no, sorry. I want to mention depreciation real quick because Henry mentioned that. I don't think we have a slide covering it. So I do want to mention this real quick. So depreciation, Henry, we typically do cost seg, right? Anything over $1 million, that's typically our strategy there. As you know, when you sell something that you've cost seg, though, there's depreciation recapture. Typically, that's maxed at 25%. And the strategy to mitigate that is typically find another property and depreciate that or a 1031 exchange. So we will typically cost seg these to maximize tax returns, to tax benefits. As you know, Trump just got elected. He's a big real estate guy. Last time he put it, the 100% bonus depreciation. So I wouldn't be surprised if he puts that in next year. And sometimes what he also does is they make it retroactive 1 year if they implement it before April. So if they implement it before he gets into office January 20th, if he implements 100% bonus depreciation before April, sometimes they'll do a look back and make this year 100% as well. Um, yeah, so that's kind of the depreciation piece, kind of the pros and cons and what we typically do here. I think we will do a cost seg for folks. But I need to run the math to make sure with the cost seg company because at 60% bonus depreciation, I want to make sure I'm doing something that's going to help you. And I just need to see the math from the cost seg company. Like I need them really to break it down to make sure we're doing that. So, okay, Brandon, thank you.
Okay. Yeah, just a little more on our little, sub-market here of St. Augustine, Florida. If you guys have never heard of St. Augustine or been to St. Augustine, it is the oldest city in America. It's really cool downtown. There, it's very historic, and we do a lot of tourism business here. But we're also a sub-market of Jacksonville, so we're only depending on where you are. It could be anywhere from 30 minutes to 45 minutes to Jacksonville. A lot of people live in St. Augustine, drive to Jacksonville for work, just shoot up the I-95 corridor. Um, if you're familiar at all with Florida, you've probably heard that Jacksonville's been one of the best markets to invest in over the last few years. Big healthcare scene in Jacksonville. Um, Baptist Health, Mayo Clinic, and then specifically we'll get to in St. Augustine, we have a big presence here, University of Florida Health, which started out in Gainesville, attached to the college, and is now a major player in the hospital space here in North and Central Florida. Government and military, um, we got big naval station in Jacksonville, and a lot of folks here locally in St. Augustine. I've got several buddies that are in the Navy, again, live here and they drive to Jacksonville. um, Finance and insurance, a lot of the big players have a big hub in Jacksonville. Logistics and manufacturing, so we have a huge port in Jacksonville, and DeSantis has made a big push to try to get the Jacksonville port up on par and competing with Charleston, Savannah, and New Orleans for some of the biggest ports in the Southeast. So the state is investing a lot of money and resources into the port. And then education and professional services, we do have several universities in and around Northeast Florida. Go to the next. So here in St. Augustine specifically, again, University of Florida Health. We do have a big Northrop Grumman has a huge presence here. We have a regional airport in St. Augustine. They're one of the largest employers in the area. Ring Power, which is like heavy equipment, Caterpillar, they have a massive operation. PGA Tour is just on the north side of town. You guys, if you're a golfer and you watch TPC Sawgrass, um, that is where that tournament is played, and that's also where the PGA Tour's headquarters are. And then St. Johns County School District, we are rated the #1 public school district in the state. It's one of the reasons why we picked St. Augustine to move to, being a special needs family, that was really important to us. And then, some other various, tech companies and that are all kind of feeding off the growth that we've seen here over the last 5 years. Okay. Tourism is huge in St. Augustine. Um, we get an enormous amount of weekend and holiday traffic here because it is a short drive from several other major MSAs in the Southeast. So you can be here in 5 or 6 hours from Miami, from Fort Lauderdale, from Atlanta, from Savannah is only a couple hours away. Charleston, South Carolina is only a few hours away. Um, Gainesville, Florida, which you guys probably, are not aware, but that little city in Central Florida is growing like crazy. We're only 3 hours from Tampa. We're only an hour and a half from Orlando, which is one of the biggest cities in the country now. So we get a lot of weekend tourist traffic, and they come in to walk the streets, go out to eat. We have a big holiday festival here. The lights during the holidays are amazing. It's beautiful. A lot of those people in those markets that I just mentioned own second homes here. So you can see in this slide just kind of the impact that tourism has on our local economy. And this particular asset, I will tell you, the traffic along A1A, which has just been renamed Jimmy Buffett Highway, is a really good, healthy combination of tourists and locals. Okay, go ahead. Pretty self-explanatory here. Median age 48. That's my age exactly. Median household income is over 100 grand, and we got, really good home ownership rate here.
100 grand's a great median household income.
Yeah.
That's good.
Um, some of the local attractions, I don't think we need to. Um, if any of you want to know about St. Augustine history, feel free to reach out to me after. And
So
tell you.
that was exactly an hour. I think I tend to lean into education, and Brandon does too. So I apologize for the webinar being long, but I always want to educate as we go. So thank you for your time. If you have any more, Q&A that we haven't answered, I think there was quite a few great questions about 12, and I believe we answered all of them. If we missed anything, please oh, let's see. Please ask. And then, yeah, reach out if you'd like to reserve a spot. Like I said, the last one was sold out pre-release, and the one before that was 48 hours. So I'll start reaching out to folks and that I have talked to, and kind of letting them know this is out there. But we'd love to have you invest alongside us in this. This is a great opportunity. Um,
And if you're worried about anyone keeping an eye on the asset, my daughter goes to school downtown. I literally drive by this property twice a day, almost every day of the week.
That's right.
Oh,
We're not absentee owners, right? Brandon is right there. He's on it. So that's an important piece. So okay. Any more questions? Let's see. I got one coming in. Okay, these aren't questions. I got two reserves just popped in there. Yeah, so reach out with any questions. When it's raise time, I'm happy to work late at night, early in the morning, get questions answered for folks. So feel free, if you got deeper questions, just send me a text. We can set up a call tonight, tomorrow, early next week if it's still available, and I'll sit down, walk through everything, any questions you have. We're in this together. The vision here is just to continue to buy like awesome properties like this with great partners like Brandon, build up these real estate portfolios, either sell them and get high returns and roll them into the next, and just create passive income so we can do what we want. As we all know, medical professionals, our jobs are not passive. We're trading time for dollars, and it's very hard, and insurance is making it harder and lack of employees is making it harder. And so real estate is just a game that the structure is just much better than medicine for supporting a better quality of life and wealth. You've heard me say this before, like the guys around here that do real estate development, own a bunch of properties, that buy right with the right partners. I mean, they're worth 100 million, 500 million, a billion. The top dentists in my area, lucky to hit 8 figures, right? Lucky to get to a $10 million net worth. So, and it's not about the money, it's about the time with our family and living the best life we can. And this industry, real estate, it's just such a better garden for that. So Brandon, I want to thank you for your time today. I look forward to doing this with you, and hopefully these sellers will have some more properties for us over the next couple of years, because the fundamentals on this one are just so good. All right, everybody, I'll stop the recording.